Have you ever wondered how to secure a steady income without constantly keeping an eye on the stock market? Well, that's where dividend investing comes into play. While it may seem a bit mundane at first, rest assured that dependable returns are anything but boring. Welcome back to Wealth Wizards, and for today's video, we'll explore the art of dividend investing and reveal its potential for wealth accumulation. Before we dive into the intricacies of dividend investing, make sure to subscribe and ring that notification bell. This way, you'll never miss our wealth building tips and financial insights. Now, let's get started. Dividends. What are they exactly? There are a number of ways a publicly traded firm can spend its profit. It may use the funds to invest in R&D, save them for the company's future, or, most importantly to us as shareholders, give us dividends. Dividend can be compared to interest you would get on a savings account from a financial institution. If a corporation has a 5% annual dividend yield and its stock is currently worth $100 per share, the dividend payment to its shareholders would be $5 each year. This steady dividend payout is a safe and reliable way to grow your savings over time, providing a steady stream of cash flow when it's time to turn a lifetime of assets into a comfortable retirement income. It frequently plays a crucial part in the portfolio of a smart investor. It is important to keep in mind, however, that dividends are never assured and that firms always maintain the right to change or remove them as they see fit. More importantly, dividends are often paid by larger, more established corporations that expand more slowly over time. Companies with a smaller market share are more likely to reinvest their profits in order to speed up their expansion, which might be an enticing method to build your wealth. Let's look at how dividend investing can help us build secure long-term portfolios, especially for the purpose of generating passive income in our golden years. If you invest in equities or index funds, you may be startled to hear that you are already participating in dividend investing. Roughly 77% of the stocks in the S&P 500 pay out dividends. You may be wondering, is it really worth it? Given that the current dividend yield on the S&P 500 is only 1.60%? Hold that thinking for a second. We're about to present you with some extraordinary dividend stock choices that may alter your outlook forever. To give some context, the yearly dividend yield of the S&P 500 stocks was reliably above 3% for the majority of the 20th century. However, dividend yields have been falling as of late because businesses have become more conservative with their dividend payments. There are a number of causes for this change. First, dividend stocks stand out as an attractive option for income-seeking investors due to the low interest rates in savings accounts and bond yields. Second, technology has emerged as a major player in the economy in recent decades. As a general rule, IT companies would prefer investing in new technologies and quick expansion than pay out significant dividends to their stockholders. Therefore, despite the fact that the current environment may be different from what earlier generations experienced, there are still ample opportunities for us to harness the power of dividend investing to our long-term benefit, especially as we aim to secure that crucial passive income stream during our retirement years. Let's take a step further into dividend investing and see how dividend reinvestment can boost our profits, laying the groundwork for a secure financial future and a steady stream of passive income into our retirement funds. Dividends continue to be a powerful instrument for improving our overall results despite the changing nature of the financial world. By reinvesting dividends, we use the power of compound interest to work in our favor. It's like sowing money-making seeds that blossom into a prosperous harvest. Let's use an actual scenario to demonstrate this. So let's say you put money into an S&P 500 index fund in January of 2000 and held on to it until September of 2020. If you had invested only in stock prices, you would have seen a cumulative return of 13.6% or an annualized return of 4.2%. Here's where things get really exciting. If you had put all of your dividend checks back into the fund at the same time, you would have earned a 6.2% yearly return for a total of 247%. If you had reinvested your dividends, your earnings would have grown by roughly quadruple their original amount. That's the awesome potential of compounding in action. As we can see, dividend reinvestment is a revolutionary concept in the world of investing, and it's a tactic we should seriously explore if we want to gain as much money as possible and ensure a comfortable retirement income. Now, we need to be clever as possible when choosing the greatest dividend-paying stocks. The dividend yield is the instrument we use for this purpose. We shouldn't get sucked in by the greatest yield alone, even though there are several websites dedicated to helping us find high-yielding dividend stocks. Imagine you have found a stock that was once worth $100 per share and now pays a hefty annual dividend of $5. Its share price has dropped to $50 due to recent commercial troubles, yet the company still distributes $5 in dividends annually. The dividend yield has increased from 5% to 10%, which may seem appealing at first glance but actually indicates problems rather than health. If the dividend yield is going up, it's not a positive sign. It means the company is struggling. Therefore, selecting dividend stocks requires the utmost trustworthiness. Is this company secure enough to pay dividends as promised and perhaps even grow them in the future? The dividend aristocrats are a group of firms that have a proven track record of dividend growth and can be used as a proxy for identifying stable dividend equities. The dividend yields of companies in industries like real estate and utilities tend to be above average. The dividend payout ratio is a useful indicator of a dividend stock's overall health. Earnings per share are compared to dividend payments in this ratio. A payout ratio of 50% would apply, for instance, if a corporation earned $2 per share in a given quarter and paid a dividend of $1 per share. Dividends with a lower payout ratio are more likely to be sustainable, whereas a high payout ratio may indicate that a company needs to increase its dividend or may be experiencing financial stress. If a company's payout ratio is more than 100%, it could be a warning of earnings pressure or that the dividend distribution is unsustainable at current levels. On the other hand, an increasing payout ratio is indicative of a stable business that operates in a competitive market and generates consistent profits. Now that we know dividend investing is effective, let's look into how to put it to use to secure a passive income stream in our later years. Here are 3 options to think about. The traditional way of thinking about dividend investments is to seek for companies with high dividend yields. In this approach, we prioritize large dividend-paying corporations that have a proven track record and strong cash flow. When we need to start making money quickly, these investments are perfect. High yields are important, but they shouldn't be the only consideration. It's possible that the stock prices of these companies won't rise as quickly as those with smaller dividend yields. If you have a longer time horizon for your investments, you may want to consider investing in firms with high dividend growth but lower dividend payouts. This approach may not provide huge dividends right once, but as the company grows, those dividends should increase. If we start investing early, we can buy more shares and earn more in dividends. Our long-term financial stability is ensured by the cost and yield benefit of this investing approach. If you're the type who learns best by doing, you could find dividend capture to be an appealing strategy. By purchasing shares just before the dividend payment date and selling them immediately after, dividends can be actively harvested. It's not quite as simple as it seems though. We must own the shares before the ex-dividend date, which is usually 2 weeks before the dividend distribution, in order to get the dividend payment. Stock market fluctuations make it difficult to know when to cash out. Any drop in price after a dividend payment could completely wipe out our dividend income. It's also possible that dividend capture will cause us to be taxed at a higher rate on any short-term capital gains we make outside of a retirement plan. Dividend investing, like any other type of investing, is not without its dangers. During the recent COVID-19 pandemic, many well-known stocks including Wells Fargo, Dick's Sporting Goods, Carnival, Goodyear Tire and Rubber, HSBC, Airbus, and Rolls-Royce, among others, reduced or eliminated their dividend payments, highlighting the fact that dividends are never guaranteed. Subtle threats should also not be discounted. As investors, we must always put diversification first. If we only consider dividends, we risk missing out on the sectors and company kinds that are essential to a balanced portfolio. For instance, it is not common for quickly expanding tech startups to provide dividends. We could be more vulnerable to market swings if we don't spread our investments around, and we could be missing out on growth opportunities in sectors that don't pay dividends or pay dividends that are lower than average if we only look at dividends. So, as we embark on our journey in the world of dividend investing, we must keep these risks in mind and apply sound investment principles to navigate towards a prosperous retirement filled with passive income. That concludes our deep dive into the world of dividend investing here on Wealth Wizards. We hope you found this information valuable and insightful. Now, it's your turn to join the conversation. What are your thoughts on dividend investing? Are you considering it as a strategy for your financial future? Share your thoughts and questions in the comments section below. If you enjoyed this video and want to continue building your wealth with us, don't forget to subscribe to Wealth Wizards and hit that notification bell. Plus, give us a thumbs up if you found this video helpful. Stay tuned for more expert insights, wealth building tips, and strategies to secure your financial future. Thanks for watching, and we'll see you on our next video.